Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital Lending here in Dallas. Joining me today, it's the man himself, the governor of the great state of real estate in Texas, Mr. Michael Becker. Michael, how are you?
All doing pretty good. How's everything going in the Old Capital world today?
Oh, we're just still in that afterglow of the Old Capital Conference that we had just less than 400 people show up for that. And I think the word on the street was that it was probably one of the nicest conferences a lot of people had been to, but mostly probably the best attended conference in the Southwest, talking about B and C properties. And I certainly do appreciate you holding your panel, Michael. And again, what did you talk about on your panel?
I always had the kind of state of the market with the listing brokers and talked a little bit about kind of how people are successful in winning deals and some of the do's and don'ts of how do you talk with and work with brokers that sell multifamily properties. So that's really kind of the focus. But yeah, no, agreed. I thought it was a great event, pretty well attended, a lot of new people. You know, I speak at several conferences throughout the year, and a lot of them are kind of the same old boring conference room of a hotel with kind of no sunlight and pretty sterile. So the venue and the attendance was both pretty great.
Yeah, again, we did it this year at the Dallas FC, the football club, the soccer field, where we'll have World Cup soccer coming next year. So we kept it in the theme of that, which handled our theme, which was Believe. It's been a very rough 2-3 years in multifamily investing, whether it was for the general partners or especially for the limited partners who brought their money in. We know it's a cyclical business, and it's important to keep your faith because it is such a cyclical business. And we've had such a long upswing before the downswing happened for 10 or 12 years that it was bound to, the bubble was bound to burst. But I think that is what we talked about, is it creates opportunities when the balloon deflates a little bit for folks that want to get in and either be general partners or be limited partners putting some of their money into these transactions and get the tax benefits. And buying real property, buying real estate is something to think about. So the podcast today is a friend of ours that we've known for a long period of time that I really want to talk about his journey, because he was originally from Northern California. And as we know, in Northern California, a lot of folks are in the high technology business. Whether it was in Silicon Valley or it was in other places around San Francisco or San Jose, this gentleman was in the high tech industry. And then he transitioned into the low tech industry. Low tech industry is real estate, owning and managing lots of multifamily properties. And he's done a wonderful job, and he's inspirational when you talk with him because he's a guy who's been successful through this little bit of a downturn. He's expanded the number of properties that he's bought. He's going to tell you why. That we've seen a lot of maybe IT people, high-tech people got into the multifamily business, were in it for a year or two, got the hell out of the business, and are now back into high-tech business again. But he's going to talk a little bit about his journey. So welcome to the Old Capital Podcast, Mr. Eric Hardy. Eric, how are you?
I'm doing well, Paulie. Thank you very much for having me on today.
Well, we've known you for such a long period of time. I think you're not only a quality person, but a good operator of multifamily properties and understanding the math behind it and being successful not only with your investors, but also with the tenants themselves, because you definitely have your heart out there trying to help the tenants create better lives. And, you know, it shows, and we'll talk a little bit about that. But Michael, if you could do me a favor, let's kick off the podcast and ask your 20 questions.
Hey, Eric, thanks for joining us, and known Eric a long time and his partner, JC, even longer, back from Wells Fargo days. But yeah, maybe just start with a background on yourself and kind of, what did you weren't always in the real estate business. So what did you do before? And then how did you get transitioned over into the multifamily space?
Yeah, it's kind of funny actually thinking about it. My very first trip to Dallas, you two were two of the first people I ever met in Dallas. We had sat and had coffee when you were actually the lender on the first deal that I invested in out there. So I kind of come full circle here a little bit. My background from the late 90s up through 2017, I sold semiconductors in Silicon Valley for some of the biggest names out there and was fortunate enough to get to see some of the big names out there today, like Google's and Facebook's and Apple's of the world, start and grow into kind of what they are today, and obviously substantially more since I transitioned to doing this full time. But I did that for 20 years, selling into everything from people making routing equipment and phones and that kind of stuff to all the data center guys. While doing that, really became interested, always had an interest and a passion in real estate, but just didn't really know a good way to do that until I met JC, as you mentioned, and he was doing the same kind of thing that I was doing. He was selling semiconductors at the same time, but in the midst of doing that, really had a passion towards doing something on the real estate side of things. He had already purchased a few smaller properties out in DFW, and I invested in one of them 13, 14 years ago, and found that I really loved the process a lot. Spent nights and weekends off of my semiconductor job learning about the business and sort of slowly just adding more and more responsibility and more to my knowledge base on doing that until I ended up transitioning to doing this full time about 8 years ago.
One thing I've noticed, there's been a lot of people that kind of were in the high tech Silicon Valley industry that buy apartments in Dallas, seemingly. And what do you think that the common causality that gets you from the high tech into the multifamily space? Why does that tend to be a common story?
I think there is something on the high tech side of things where you've got people that are making a whole lot of money on an annual basis. I mean, you call high net worth individuals, but don't really have something that would be called a follow-up or a backup plan, any kind of a retirement plan, any kind of a pension that just doesn't exist. And so a lot of people you'll see that are in golden handcuffs forever because the moment they stop, they go from earning, very, very large sums of money to essentially nothing at all. And that was one of the things that attracted me and has attracted a lot of the investors that we have, is using real estate as essentially a pension plan. Yeah, not only a pension plan, but a very tax advantaged one. These people that are making hundreds and hundreds to millions of dollars a year can invest in real estate and get cash flow from that real estate. And with depreciation, that those taxes are deferred and you're not getting taxed at the highest tax levels in the country, especially many of them being from California.
Now, you grew up with a silver spoon in your mouth because your dad was a big-time real estate investor, wasn't he, Eric?
No, not at all. Both my parents were teachers for 30 years each. I grew up in the mountains in the middle of nowhere, went to school at UC Davis in California, and then sort of fell backwards into the semiconductor and the real estate side of things. So no, I did not have any background in real estate at all. So all of this has really been through a whole lot of reading and continued incremental learning and knowledge over a lot of years now.
How do you get into this business? I mean, you happen to have a partner that kind of inched you along, but what do you see today? How are people getting into multifamily investing? What's the first step that you think people should probably do?
Realistically, I mean, a bit of a shameless plug. I would spend a lot of time listening to people like yourself. This podcast, I would spend a huge amount of time finding resources on reading. I read on our industry every day when I feel like I learn new things weekly. There are a lot of resources out there, but I would really first educate yourself and also spend a lot of time vetting both the resources that you're using. And then if you are looking to get into something, make sure you're vetting the people you're getting into and you're getting into deals with if you're going to be an investor. All of us have known quite a few people who have lost all of their money in deals over the past few years doing things that were very, very risky. And I would certainly make sure that there's no easy ticket here. This isn't just, you just throw it in and put your head in the sand and just, collect checks every quarter. Make sure you are really doing your homework, both from an education standpoint, if you are looking to potentially do this long term, but from an education standpoint around the partners and the people you choose to partner with or to give your money to.
So yeah, you mentioned that obviously we've had probably three, maybe a little bit longer now, years of a downturn. Kind of our market, our asset class has certainly been dislocated in the recent years, and a lot of that was kind of a major run up, like Paul referenced. It's probably held 12 years maybe of a bull run with maybe a little panic there and COVID, and then blow off top right after COVID and 21 and the first half of 22. So what was the first year that you invested as a passive investor, Eric? What year was that?
2011.
2011. Okay, cool. And then when did you said you became on the principal side at what year?
2000. Well, when I started really doing this more and being more deeply involved within a couple of years after that, maybe a year or two after that. I kind of
Okay. So you got to participate and benefit from the good times. It's a cyclical business, and it's not always, today is, pretty dark and, seeming like the light's starting to get a little bit brighter depending on kind of where you are. We need to, my view, clear out a bunch of the dead weight here. It just needs to kind of be cleared out, and nature's kind of healing. So we're in the process of kind of finally recognizing all the losses that are on paper, and those that don't have, 3-4 years of ability to stay alive for 3 or 4 years are going to get washed out. But, 3-4 years from now, we should be in a materially different place than we are today with materially higher values, or that's my view of the world, at least. So for those that are kind of newer in the business, what was it like when you kind of made that transition, call it 10 years ago or so, from being a passive into being, principal in these deals and being active? What was it like kind of getting those first deals done, and what were some of the differences from like today to back then, and kind of, how easy or difficult it was then compared to today?
I was fortunate in that I did the transition in a pretty measured way. I had the ability to sort of slowly add to the amount of time that I was spending doing this, and didn't just decide to completely jump into this. My business partner and I were both doing full-time jobs in Silicon Valley, and incrementally we were adding an apartment complex, roughly about one a year for a number of years. And to your point, that was absolutely in some of the good times. I think we've talked about this before. If you had bought everything you saw, and from 12 to 17, you would have been in a great spot, right? If you bought everything you saw in 2021 and 22, you're in the exact opposite spot, where you're, to your point, many people losing pretty much everything they have and then some. I was fortunate that I could do this in a measured pace and not just drown myself in it. So we would very strategically look for deals that fit us, that we could digest and make sure that we had our arms around. When we started off doing this, everything was agency debt and long-term agency debt. And when values were going through the roof, those prepay penalties, we didn't look all that intelligent at that point in time. But we kind of held to that, with the exception of a couple deals where we had to take on bridge debt due to the nature of it being a lease up or construction. But when rates skyrocketed 5% in a year and a half, or even less, we were really fortunate that we had fixed so many of those loans that was not a concern to us on most of the properties we had. So we really took a pretty conservative approach. And for a while, we were pretty wrong because of the prepay penalties we had to pay when we sold some of our assets. But in the end, the downside risk was mitigated substantially. So we weren't freaking out when interest rates hit a whole lot of people at the same time.
So besides taking long-term fixed rate debt on the front end, what were some of the things that you looked at back 10 years ago? What were the characteristics of a deal that made sense for you guys to go ahead and pull the trigger and buy it?
We always looked at cash flow. For us, taking the long-term approach and having the kind of investors that we have that are more high net worth individuals, they're not looking for us to turn around and guarantee them we're going to double your money in 2 or 3 years, which is what we have heard from so many pitches over the last quite a few years here. We really looked at this and pitched this as something that is very tax advantaged cash flow for high net worth individuals. And yes, there will be forced appreciation over time, but we were really looking for something that cash flowed from day one and had a very reasonable pathway to continue to increase that cash flow. A lot of it early on when you're looking at rehabbing and renovating a property and adding upgrade units. we looked for places where rents were under market for the area. And not only were the rents already under market, but we could actually upgrade units and have a pathway to increase rent through doing that as well. So we were always much more cash flow focused.
And those units, for those that are kind of newer in the space, so
Sure.
say, take you back 10 plus years ago, you'd be buying a 70s deal and you'd be paying, what, 40,000 something a door, maybe
Yeah,
30 to
something like that.
50,000.
70s and 80s deals. We picked up an 80s deal for 50 some thousand a door, so it was, yeah.
And then these renovations, so you would probably project what, $100 rent increase, and how much would a per unit renovation cost to upgrade the interiors back, say 10, 12 years ago? 4 or 5,000 a door?
Yeah, it was probably, 4 to 5 thousand a door. And then I think we went to sort of, 5, 6, and 7 if you were a 1 bedroom, 2 bedroom, or a 3 bedroom, 5, 6, and 7,000 a door. And then they kind of have incrementally sort of moved up over time.
And so now that's 10 to 15,000 a door?
8 to 10, depending on how much you do. I mean, if you put in granite, do you not? I mean, so there are certainly aspects now. Do you do a full renovation is easily 8 to 10 a door, no question.
Can I step back really to figuring out this is a two really partner portfolio that you guys run? You could probably say third person, but really it's really just you and your partner. And you guys are not the same. You guys both have superpowers, because if you had the same power, it would be just redundancy. And you probably wouldn't need one of the two of you guys to be in the partnership. What is your superpower and what is your partner superpower?
That's a good question. So yeah, I mean, you're absolutely right. There's two of us, and to your point, there, a third who is our VP of operations that runs our in-house property management in Dallas. And realistically, between the three of us, we make, all the decisions around what goes on, and we all have different viewpoints when we're looking at and tackling a problem. JC, my business partner, I think his superpower, he is always willing to look in time and look at things and push the boundaries on things. And whether it's virtual, people working remotely, as in not just people in Dallas supporting us, to AI, he's willing to look at things a little bit ahead of the curve. I can tend to really be kind of deeply in day-to-day side of things and looking at that. Whereas he absolutely is always kind of looking out ahead of where we're at and exploring some of the new technologies in the future that can support us. And he pushes us as a team to do that. I think my superpower, other than being strangely in love with the math side of things on this, I'm pretty calm under pressure. I was in the middle of a lot of very high stress situations in Silicon Valley with hundreds of millions of dollars and to more on the line. And I think that really taught me to be calm under pressure. It's, not every day is a picnic. When you get a giant hailstorm that wipes out roofs or windows or both, and, things like that, it's okay. Let's dig in and solve the problem. It's not a Chicken Little situation. And so for me, I'm pretty calm when it comes to dealing with things that inevitably will go wrong. And I've always said, we get paid more so for solving the problems and fixing things when they go wrong rather than just when they go right.
So talk to me a little bit. People don't understand the size of the transactions that like you guys are doing right now. Can you walk me through maybe the last 2 or 3 years of transactions you guys have acquired or built? So talk to me a little bit about what you guys are doing and what you're seeing out there.
To Michael's point, in that kind of 2020, 21, 22 timeframe, I've joked a lot that I said no an uncomfortable amount of times to deals that were put in front of us. What we did find and were able to find out a bit of a niche in this was a new construction aspect. So in 2021, we were able to purchase what became a phase one of a brand new property out in Van Alstyne, so to the northeast of DFW Metro. And as part of that, we were able to partner with the construction team that built that phase one and rezone the next door piece of land and add on a phase two to that. So the initial purchase was 132 units. And then they went on and built another 96 units, so an additional 4 buildings for us. Over the course of the next year and a half, we were able to rezone that land and build onto that. So that became a 232 unit apartment complex. Through that process, we realized that, and I looked at this early on, that what we do well, they didn't, and what they do well, we didn't. We did not have a construction arm or an ability to do that without just hiring a third party. This group was a very small group and didn't really have any operations. We have a set of investors, a set of operations, a way of managing all of our investors. And so we just fit very well with them. So we kicked off basically a brand new construction project from scratch with them. It was a 2-phase build that became 264 units. They just finished the build on that. That's what we did for a couple of them. And then very recently we went backwards and bought a mid-90s deal up in Sherman. That was just a great opportunity where we actually partnered directly with the Sherman Housing Authority there to dedicate half of the property as affordable in exchange for decreasing our property taxes and partnering with them directly on that deal. So rather than a traveling HFC that we saw so many of, we actually partnered directly with the local housing authority to do that. And it just made a lot of sense when you looked at the numbers. When you're taking away your property taxes and making those deterministic rather than something you have to argue with the taxing authority every year.
How big of a property was that?
It was 256 units.
Before you guys got into construction, I just want to step back because a mutual friend of ours kind of introduced to the construction builder, because you guys had never built an apartment project before you guys got into Van Alstyne. But Nick Flewellen is a great multifamily broker here in the Dallas-Fort Worth market, knew the developer in the phase one wanted to possibly sell that property, but he brought the opportunity to 5 or 6, 7 other investment groups to see if they would buy the phase one, and you were in the mix. How did you guys win that? And again, you've talked a little bit about how one domino affects the 17th domino, that you guys did not have a relationship. Nick helped you get that relationship, and now you guys have built a number of apartment buildings and partnered up together. But talk to me about a little bit of horse trading in the multifamily business.
Sure. We were in the process of looking at selling a couple of our apartment complexes at the same time when we were working on trying to win and get this deal. And so we worked with Nick on putting a package deal together to get those to him. And obviously we still had to be competitive to be able to win the process. And ultimately, through that, I think it was a combination of being able to list those deals with Nick, but also, a really fast relationship and a complementary relationship that, started with that introduction from Nick, but with the developer, and, both sides of us realizing that this could be something more than just a one-off deal.
Maybe take a kind of like a 10,000 foot view here. So you've done quite a few things, Eric. So you've done everything from kind of smaller workforce housing deals to ground up construction, kind of everything in between. You partner with the housing authorities. So you got a pretty varied set of experiences in the industry since you've kind of left the semiconductor space to now. As someone that's kind of starting out, we haven't had a kind of a advice to new people, seems like you said that you took kind of a measured approach, kind of a little bit more drawn out process, kind of something similar to how I started, where I still have my job and did some deals and gained some, track record and confidence in my abilities, and incrementally kind of went from there, grew before I jumped out and went out on my own. So kind of had a base before we went out. So I think that's pretty sound advice to somebody. You guys kind of started and really stayed in your lane from a deal size. So at least my perspective of you guys, when, looking back 10 to 15 years ago, these deals were kind of incrementally bigger than the next one, but nothing was like a huge leap forward, where I think I saw some folks at the peak, really kind of went from nothing, never to 400 units in the hood or something like that with bridge debt and all the things. They're just kind of tell you how wild it was and how easy it was to raise capital. You guys were just kind of like going from 20 units to 50 units to 100 units, and so kind of just incrementally taking those steps, with a year in between each of those, as you kind of mentioned. So I think that might be some good advice. Is there any other things that you learned that over the years, if you kind of going back to the onset of your career, that you would take some lessons you learned in the recent years and apply them? Because you guys obviously didn't make too many terrible mistakes, but you noted long-term fixed rate debt on some of those older vintage deals. I did the same thing back in that same time period and paid tens and tens of millions of dollars in prepayment penalties with yield maintenance. So it was safer, but it came at a price. So there's nothing free in this space. Any other kind of thoughts or advice to a newer investor in the space?
Yeah, I think exactly to your point of kind of what you were saying is I would say, walk before you run. First deal that we ever did, you were actually the lender at Wells Fargo, North Story Apartments, 61 units built in the 1960s. And we raised
Terrible foundations.
awful foundations,
Did it
unbelievable.
have aluminum wiring? I can't remember if it had aluminum wiring or
Yeah,
not.
yeah, it was. It's sort of everything that is so scary right now. But we raised, I don't know, $500,000 from five of us, right? And then we, to your point, incrementally grew from there. We bought Amber Creek in Garland, which was 64 units in 1980s and much better product and much better location and no foundation issues. And then bought a 128 unit deal in Garland and a 100 unit deal in Garland, and then bought 100 and change in Fort Worth. And we incrementally went into this. It wasn't something where, hey, to your point, I'm going to go buy a 1985 deal in a really bad area that's 400 units and has 10% of the units down because I'm going to fix this and I know what I'm doing. I mean, don't try to swallow the whole cow in one bite, right? So I would say incrementally do this. Make sure you've really done your homework. If you're jumping into this, make sure that you really spend some time educating yourself and start small so your mistakes can be small. When you go that big, your mistakes are big. The amount of investor money you lose is big. And so make the mistakes on smaller things. It doesn't have to be, you hit a home run in the first at bat. That would be my biggest take. And look for things that really fit your eye, and don't buy something because you have to do it. Buy something because it's the right fit for you.
And so kind of just now fast forward today. So with all the deals you've done and the kind of, up and down and variety of aspects you've been focused on in the space, what are you excited for now? You have some new construction deals, but then you mentioned you bought a 30-year-old deal, 90s vintage deal. Where do you see opportunity as you look out at the world right now? What's catching your eye? What segment of our space has you most optimistic or opportunistic, I guess, let's put it that way?
Yeah. If you say that the thing that I like the most right now would certainly be the new construction, but the reality of where, we have built and where our core competency is, there's a lot of supply right now. And so I don't see us doing something brand new in that space for a little while, unless it's in a little bit different location from where we built, because we just need to choose through some of the supply. And that's certainly happening. But so that's some of my favorite things to do. But going back to buying a 30-year-old deal and fully rehabbing it and bringing it out of the 90s and into the current day is also a lot of fun and really brought us back to kind of our roots and things that we're very good at. We're very good at transforming, existing spaces into something that looks truly modern and brand new, and bringing units out of, 30 years old into something that looks really very similar to new constructions. I think there is absolutely going to be opportunity to your point. I don't know. We're still kind of trying to find a place where buyers and sellers agree on a price, and I think that there's an end of a rope for a lot of people. I think to your point also, banks have kind of decided that they're kind of done, and we're seeing those things start to roll off, and we'll be opportunistic in places where we find things that are in a good neighborhood at a reasonable basis that allows us to put our stamp on it. And absolutely, if I find something that we can build again with the partners that we have, we will do that. So those are kind of two very, very disparate things, but the things that I think that we've proven that we're good at and fit our eye pretty well.
What are the metrics, or what are a couple of things you're looking for as you kind of look on the older end of the spectrum? What are the things that are going to make you say, okay, hey, I'm going to take my wallet out and go, put some money down on that deal versus not? What are some of the things that will get that buy decision to be yes?
Yeah,
Like IRR, upside and rents, per unit, cap rate, things like that.
Yeah, I mean, certainly we've already seen, dramatic decreases in pricing per unit. I want to see something. It's kind of back to almost our roots of when we were investing in, 14, 15, 16, 17 of, hey, what is this price? What's the price per pound here, right? If you can get a, dollar per door that really fits well, but there is clearly growth both on the rent and growth. If you can force some appreciation in upgrading units, that's certainly interesting. I think there's probably a floor through which I don't see us going back to 60s and 70s kind of stuff, but I'm looking for good bones and things that are existing anywhere from the 80s to 2000s. I think we're in a spot where we're going to start to see some interesting opportunities there. And so we will definitely be opportunistic. We're not out actively looking at everything we can find right now.
Everybody wants their children to be successful, and you have two lovely children. One's in college, and one is about to graduate in the future from high school. That one that's in high school, we would hope maybe wants to get into real estate, whether it's an owner or manager or something that has to do with real estate. I think he's found the passion by watching you in this business. What's your suggestions to him of things that on the pathway to success, since none of us had parents that were in real estate, what would you tell that person coming out of high school, going to college? What should they be learning, looking to do, classes? Who should they be talking to? What's a little bit of a push on the parental side that you would think would work?
My thought process around that is to get exposed to as many aspects of what goes into our jobs as you can. If you're a college student that's looking to get into this, I would try to figure out how to spend time with the people that run these properties, the maintenance people that maintain these properties. If you truly want to be an owner, I think there is such a broad amount of things that we have to do as owners, whether it's insurance and taxes or legal, going through all of those aspects and the underwriting aspects. I want to see someone like that and someone like him spend time in what does it take to actually run the operations at a property, spend time with people like yourself, spend time with the lenders, the people that are lending money on these deals to see how they see these deals from the outside, and spend time with brokers, people like Nick and those that are selling the deals. If you have an inside track on how they see things and understand how they see the world, it can only help you, because we have to work with all of them. We have to work with banks. We have to work with the lenders. We have to work with you. And so we have to work with the brokers. If you understand better the aspects that go on to each one of those jobs, I think it's only going to help you when you start to look at running and owning something yourself.
Makes sense. Michael, any last questions before we wrap this up?
No, I appreciate you coming on and kind of sharing your experience over the years. Again, it's been pretty varied, and I've seen your kind of growth from North Story to today. Kind of North Story, for those that have never seen that deal, was a real piece of crap that he bought and spent a lot of money on, and those foundations were among the worst I've seen. Not saying the worst, but certainly top.
Pretty high up there.
Yeah, certainly near the top of the list. Kind of wavy floors and a bunch of issues. So you kind of took that on, but it's been good to kind of get to know you over the years, and actually had some cool boondoggle experiences as well. And got to get to know you and your wife, and it's been good to kind of see you grow. And those that are kind of newer in the space, I think is looking to someone like Eric and some of his experiences and the ways to do it. It wasn't perfect, and he certainly made some mistakes along the way, but got the major things right, and was pretty disciplined and measured in his approach. And the discipline certainly went away about 5 years ago, and now it's back in a big way. And but those that haven't been in the space certainly have their backs clean. I think is a great opportunity to start really getting educated. I think there's some great opportunities today, and I think there's a bunch of opportunity that's going to be coming up in 26 and 27, especially in the older vintage. The newer stuff, I think, especially in the Dallas-Fort Worth area, we're kind of off the bottom and starting to kind of move again. And there's certainly some opportunity across the spectrum of property grades, Paul, from the A to the C, but certainly there's going to be a lot of opportunity in the workforce housing. The market is clearing in real time. Bases are getting reset market wide, and there's going to be some opportunity if you're selective and the better located. And for the older vintage deals, you just focus on kind of the better version of that, I think, and just watch some of the physical characteristics like aluminum wiring is a thing to overcome, and chillers are tough things to overcome. And, if you get PVC sewers and, concrete parking lots and individual, HVACs that are on the ground, not on the roof, water heaters, not boilers, things like that. Those are just some characteristics that if you get most of those right, those are going to make your ownership experience a little bit better. And that might not they kind of look the same from a new person's perspective, but owning 20,000 units over my life, there's definitely some differences in the characteristics of them. And I'm sure those are things that Eric are going to take into account when he's looking to go back in time and buy some of those older deals, and just make sure that he's got the better version of that and the better location near retail, near better school districts and off major thoroughfares versus being kind of a little bit more tucked back inside neighborhoods. And to steal a phrase of Paul Peoples, kind of buying a sea of C's where you just got, a ton of older workforce housing all in dense areas. So, those are things that I'm kind of, as we go back in time and are starting to make selective bets in the older vintage properties, those are the things that we're certainly taking into account on we want to pursue this property versus that property. And, I'm not going to go load my whole portfolio up with that. But, I think there's some selective bets here and there that you can go in, buy good value, reposition it. And those newer buyers that don't have the track record, your phone calls getting picked up and returned by the brokers, and you have as good a shot as you've had in a very long time to be taken seriously. So get in the mix, and markets are cyclical. We're seeing interest rates are going to come down on the short end of the curve. That seems like a mortal lock with the way the rhetoric's coming out of the White House. And Jay Powell's out in about 6-7 months as we record this podcast. So rates are going lower, and that should, last time they did that, the apartment market went to the moon. So, not saying it's going to be exactly like last time, but directionally, I think we're at a good entry point. And those that are, looking forward to getting into the space, heed some advice from guys like Eric, and I think it'll do just fine.
Eric, any final comments or suggestions or heartfelt thinking about being in the multifamily business? It's been good for you. What else would you have done? Anything different in the last 15 years when it comes to multifamily?
Couldn't agree more with what Michael said. If you're looking to get into this, make sure you look for things with good bones. And I won't repeat all the things that he said, but good bones and good location, those are critical and set you in a good path for success. And if you're looking to get into this, now to Michael's point, it's a great opportunity where brokers are actually going to be listening to people that are credible, real buyers in the market that we're in today. And yeah, for me, I feel like the path that I took on this was the best one for me. Certainly, I could go back and tell myself to buy 2 deals a year starting back in 2012, but that might be the only thing. But I feel like I had the incremental learning and the path that was best for my situation at the time. And probably the only thing I would do is that I was looking at things that were 9 caps and going, I don't know about this. So obviously, we're still not even in that space today, but not recognizing some of the value that I had in front of me because I was so new at this. So,
if somebody wanted to get more information and kind of talk with you, Eric, what's the best way for them to get more information about you and Multifam Group?
Yeah, so my email is Eric, ERIC, @multifamgroup.com. That comes directly to me. We also have multifamgroup.com, which is our website if people wanted to go up and take a look at the portfolio, both that we have today and things that we've owned in the past. That's also a place where an investor or a potential investor can go on and create a profile. And we always have conversations and get to know each of our investors to make sure that we understand and that we're on the same page around how we think about the world and what their expectations are, just to make sure that we're not missing something.
Yeah. You and your business partner, JC Castillo, who we've had on in the past, have done a wonderful job for the investors for multifamily property groups. So great. Eric Hardy, thank you for spending some time with us. The governor of the great state of real estate in Texas, Mr. Michael Becker, thank you for being available for your podcast. Appreciate that. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.